Hey everyone, welcome back to the channel. I'm Marvi, and today we're doing something big. Picture this. Two of the most powerful countries in the world. Both have massive economies. Both have millions of businesses. But one of them has twice the national debt of the other. That country with the double debt? That's the United States of America. And the one keeping it tight? Germany. So today, I, Marvi, am going to break down exactly why this happens. We're talking financing systems, business funding, government debt, and risk. By the end of this video, you will never look at money the same way again. Let's get into it. The two systems explained. Okay, first things first. To understand why these two countries handle money so differently, we need to understand their financial DNA. The United States runs on what experts call a market-based system. Think Wall Street, think stocks, bonds, venture capital, private equity. In America, if you have a business idea, you pitch investors, you go public, you raise money from the market. It's fast, it's aggressive, it's exciting. It's basically the financial equivalent of a reality TV show where everyone's competing for funding. Now Germany, totally different vibe. Germany runs on a bank-based system. Here, businesses, especially small and medium ones, build long-term relationships with their local banks. The bank knows your business. The bank trusts you. The bank funds you. Think of it this way. The American system is like going to a huge, crowded marketplace and convincing strangers to invest in you. The German system is like walking into your neighborhood bank where the manager knows your name, your business, your grandfather, and gives you a loan based on trust. Neither is perfect, but they produce very different results. And that's what we're going to unpack today. How businesses get funded. Now let's talk about something every entrepreneur cares about. How do you actually get money to start or grow your business? In America, the answer is often venture capital, angel investors, IPOs. If you've got a great idea and a great pitch, you can raise millions in weeks. That's why Silicon Valley exists. That's why America produces the most billion-dollar startups in the world. But here's the thing, and this is where it gets interesting. Germany tells a completely different story. In 2022, venture capital investments in Germany were only 0.09% of GDP. That is significantly lower than the US, UK, France, and even South Korea. 0.09%. So how do German businesses survive and thrive without VC money? Simple, bank loans and self-funding. German business owners are actually famous for not wanting outside investors because they don't want to lose control of their companies. And honestly, I kind of respect that. There's something powerful about building a business on your terms, not an investor's timeline. So, who wins here? For speed and innovation, America wins, no question. For stability and control, Germany takes the trophy. Government debt and spending. All right, people, this is the part of the video where I need you to pay close attention, because we're talking government debt, and the numbers are wild. The United States has a debt-to-GDP ratio of 122%. That means America owes more than its entire yearly economic output. The government spent $10.9 trillion in 2024 alone. $10.9 trillion. I don't even know how to visualize that. If every person in America spent $32,000, that's what the government spent in 1 year. Now look at Germany. Debt to GDP, 63%. Government spending in 2024, $2.32 trillion, which is 49% of their GDP. And here's the twist. Even though Germany spends a higher percentage of their GDP on government services, they still manage to keep their debt way lower. How? Because Germany has historically been obsessed with what they call fiscal discipline. In fact, they literally wrote a debt brake into their constitution, a law that limits how much the government can borrow. Now, and this is big 2025 news, Germany actually just passed a historic €1 trillion spending package. 500 billion euros for infrastructure, 100 billion euros for defense. So even disciplined Germany is starting to loosen the belt. Is Germany starting to act a little more American? We'll talk about that at the end. Risk. Who bears it? Here's a question most people never think about. When things go wrong financially, who actually takes the hit? The individual? The bank? The government? Future generations? This is what economists call risk sharing, and America and Germany handle it in completely opposite ways. In the US, risk is spread wide because there are so many different financial instruments: stocks, ETFs, bonds, derivatives. Risk gets distributed across millions of investors at the same time. If one sector crashes, others might hold up. It's like spreading your eggs across 100 different baskets. In Germany, risk is shared differently, across generations. Because German banks hold long-term relationships and aren't as exposed to volatile markets, the system can smooth out economic shocks over time. Today's generation and tomorrow's generation share the burden together. Now, 2008, the financial crisis. Both systems got tested hard. America's market-based system nearly collapsed because risk was so interconnected through complex financial products that nobody fully understood. When one domino fell, they all fell. Germany still hurt, but their bank-based system, with stricter regulations and less exposure to toxic assets, absorbed the shock better. In fact, after 2008, Germany banned naked short selling and forced banks to separate risky trading activities from regular deposit banking. Lesson: spreading risk wide is great until everything crashes at once. The verdict. Okay, we've covered the systems, the business funding, the debt, the risk. So now, Marvi's verdict. Which country wins? It depends. I know. That's not the exciting answer you wanted. But hear me out, because this is actually the most important part of the whole video. America wins if your goal is speed, innovation, scale. You want to build the next billion-dollar app. You want to go from zero to IPO in 5 years. America's financial system is built for that. The capital is there. The investors are there. The appetite for risk is there. Germany wins if your goal is stability, longevity, control. You want to build a business that lasts 100 years, stay debt-free as a nation, and make sure your grandchildren don't inherit a mountain of financial problems. Germany's model is built for that. And here's what's really fascinating in 2025. Both countries are slowly borrowing from each other. Germany just unlocked a €1 trillion spending package, moving toward more aggressive investment. Meanwhile, America is having serious conversations about fiscal responsibility and debt ceilings. Maybe the future isn't USA or Germany. Maybe the future is a system that takes the best of both worlds: American innovation and energy with German fiscal discipline. Now that would be something. All right, everyone, that's a wrap on today's deep dive. Let's do a super quick recap. 1. USA is market-based, Germany is bank-based. 2. America dominates venture capital. Germany dominates bank lending. 3. U.S. debt is 122% of GDP. Germany sits at a much cleaner 63%. 4. America spreads risk wide. Germany spreads it across generations. And 5. In 2025, both countries are evolving. Now I want to hear from you. Drop in the comments, Team USA or Team Germany? Which financing system do you think is better and why? I read every single comment. If you enjoyed this video, smash that like button. It genuinely helps this channel grow. And if you're new here, subscribe, because we break down global finance and economics in a way that actually makes sense. I'm Marvi. I'll see you in the next one. Peace.